Hello Trade Pros, my name is Mark, a trader here at TRADEPRO Academy, and I'm excited to have you guys on the channel. Welcome. If this is your first time here, welcome to the channel. If you're a returning viewer, welcome back. Before we get into the topic of the video, if you guys have a moment, please go ahead and subscribe to the channel and make sure to check out that notification bell to get notified anytime we go live or drop any new videos like this one. In addition to that, if you guys can go ahead and smash that like button, that's really going to help us out with the YouTube algorithm. It will help put our channel out in front of other traders such as yourselves. All right, welcome back Trade Pros. So by now you've gone ahead, subscribed to the channel, you've checked off that notification bell, and you've liked this video, and I've got the reception from that so I can go ahead and proceed. This is the topic for today's video, and it is going to be on the number one rule that 99% of day traders break. Now, before I actually give you guys, I spill the beans on this rule, I'm curious to know what you guys think it might be. Go ahead and comment at the comment section of this video to see what you guys think is that number one rule that day traders will break. Now, don't cheat. Don't wait until the end of the video to comment. Make sure to comment on this before so that we can see if you got the answer right or not. I'm going to give you guys a second to do that, and we'll see you in the next slide. All right, Trade Pros, so you guys have gone ahead and made your guesses, and here is that rule. Here's the number one rule that 99% of day traders break. I broke it myself. I know a lot of the guys here in the office broke it when they started, but we've learned from it. And the idea here is to help you guys identify, the big mistakes that can really blow your accounts based on our experience so that you don't make those same mistakes, or so that you guys have actionable ideas or tips in order to prevent yourselves from making the mistake. So what is the big rule that 99% of day traders break? This one right here, all right? For those of you that can't read my chicken scratch, what this says is removing or canceling stop losses. In other words, not honoring your stop loss rules. In other words, holding on to a loser. In other words, not wanting to crystallize a loss. And so guys, this one is a really, really big one, and we decided to make a video in itself just for this one topic because we see that a lot of traders struggle with this. We worked with a lot of traders that are struggling with consistent profitability, traders that are at the break-even stage but are just having a difficult time holding on to the profits that they make, not making the profits, but holding on to them. And when we ask, what's going on, why are you having a difficult time keeping those profits, a majority of the answers that we get, to be honest, are I can't seem to respect my stop loss. I can't seem to just take the loss and move on. I tend to give profits back to the market as a result of not honoring my stops. I tend to hold on to positions for too long, let them turn into losers because I want to be right instead of making money. Now, it seems a little bit illogical that, wanting to be right is keeping you from making money, but that is what's so interesting about trading and trading psychology, is that a lot of what we're taught growing up is actually illogical when it comes to trading, right? Imagine this, as you're growing up, you're going through elementary school, you go through high school, through universities, you're always being graded on your accuracy, on your correctness. Your grades on exams are based on how many you get right versus how many you get wrong, etc. So all the way throughout our life, our initial feedback, our feedback mechanism is whether we're right or not. But with trading, the interesting thing about trading is that with proper risk management and risk to reward, you can be wrong more times than not, and you can still make money. So this goes against what a lot of people grow up understanding and believing it. And so it becomes somewhat of a limiting belief that I have to be right in order to make money. You don't have to be right in order to make money. You have to follow your rules. You have to have a good risk reward ratio, and you have to have strict risk management. So let's take a look at some of the reasons why people do not honor their stops. All right, guys, so one of the first reasons why a lot of traders have difficulty honoring their stop losses is simply because they have the need to be right. Like I said in the intro to this video, growing up, we're almost learned to become right, to focus on accuracy, to focus on correctness. And in this industry, it couldn't be anything further from the truth. Like I said, you can lose more trades than you win and you can still make money. You wouldn't go to a surgeon that completes 40% of the surgery successfully, would you? No. And so that's why it's so difficult to remove the ego and the need to be right and simply to follow stringent risk management and a good risk to reward ratio. Let's take a look at reason number 2 why traders typically have difficulty respecting their stop loss rules. So reason number 2 why traders typically struggle with respecting their stop loss rules is because they get married to their trade. This one's important, guys, and you have to remember, especially as a day trader. As day traders, we're not going to be holding on to positions. Whether you're trading FX, whether you're trading futures like we do, or whether you trade stocks, we are trading small price fluctuations. We're not trading the fundamentals of the companies. We're not trading the fundamentals of the economies in the case of currencies. We're not trading any of that. So why hold on to your bias when you're in the trade? The idea here is that you're not getting long or you're not getting short because of fundamental factors A, B, and C. You're likely getting into that position because of the short-term price fluctuation. Price is likely either overbought or oversold at some point in the markets, and you're just looking for that reversion right back to the mean, right? That's it. As day traders, we're not looking to capture crazy moves. We're just looking to capture small price fluctuations. And the thing with that is if you get into a trade and then you start arguing for reasons why you should hold it when everything is telling you you should dump it, you're likely married to that trade. So the most important thing you can do is to be able to take a loser, is to be able to crystallize that loss. And that takes us into point number 3 on why traders typically find it so hard to respect their stop loss rules. So this is number 3, guys. Taking the loss means admitting defeat. The way that a lot of traders work, especially the newer traders, the ones that haven't really focused on psychology or mindset training, they are the ones that often struggle the most with this because they feel like when a trade is running in unrealized profits, it's not crystallized. It can always come back. I can make the money back. All it has to do is just come back to where I took it and I can get out for break even or for no loss. And that doesn't always work. In fact, it hardly ever works. And the reason why traders have trouble admitting defeat is because that loss crystallizes the loss. It basically means I admit defeat. I was wrong in my analysis and I took the loss. We're gonna offer you guys some solutions towards these issues towards the end of the video, and you'll be seeing that coming shortly. All right, trade pros. So we've discussed some of the reasons why day traders break that number 1 rule of honoring the stop loss, right? And we've discussed the reasons behind that. Now it's time to give you guys some actionable advice so that you guys can go forward and use some of these tips in your trading so that you can prevent making these same mistakes. Practical tip number 1 is to accept the risk. All right, it sounds basic, it sounds very simple, but at the end of the day, you cannot succeed in trading until you accept the risk. What we're doing is inherently risky, right? But if you think about it, and this is something that George brings up quite often, what on a daily basis is not risky? Eating chicken, you can get salmonella. Leaving your door to take the bus in the morning, you can get hit by a car. That's risky, right? Do you think about that though? Probably not. So why do you put so much risk or pressure on trading being risky? If you guys treat trading like a business, it can help you accomplish your life's dreams and whatever that is, whether it's financial freedom or just having a little bit more time throughout the weekdays to spend with your family. Or if you like adventure, it's being able to go off and go cliff jumping, cliff diving, whatever you enjoy doing. And so if you flip your mindset and you flip your thinking to accepting trading as a means or as a catalyst in order to make your goals possible, then it becomes less risky, right? What other industry can you control the downside? All right, this is one of the things that we can control in the industry. We can't control whether the trade itself is a profitable trade or whether it's a loser, but what we can control at the end of the day is the risk. And so we're at complete control of that. And before we can make money, you gotta be able to accept that fact. You are in control of the risk. And so long as you accept the risk and you qualify your trades based on your trading plan, your setups, then there's no reason to be scared. Because what's trading going to do for you? Trading is going to help you achieve the dreams that you want. All right, Trade Pro. So once you've gone ahead and accepted the risk that trading is going to help you accomplish your dreams, and that you are okay taking the risk required in order to make that happen. Actionable tip number 2 is to break up your trade idea into layers. Now I know this sounds a little bit confusing, but let me explain. So let's say that you have a resistance level up here, right? And let's say you want to get short at that level, and let's say the market is starting to climb towards it, right? What you can do, let's say on a normal trade, on average you trade anywhere between 3 to 4 lots. I'm using the example here of futures. If this is equities, you can say several hundred shares, let's call it 500 shares. With Forex, it would be units, all right? So 10,000 units, 100,000 units, however you want. What you can do is you can allocate these lots into several layers across the level that you're looking to get short. And so what this does is, let's say 3 to 4 lots is 1% of your account capital. What you can do is say, I want to set a sell limit somewhere just below resistance, and I'm going to allocate 0.25% of my account size to that idea. And then you can essentially layer that up to 4 different price levels within that resistance zone that you're looking to get short. So what that will effectively do is, if the trade comes through, if the market trades all the way up into your 4th level, you're going to get filled on all 4 of those positions, and you're going to be exposed to 1% risk. However, if you don't get filled on the ones up here, and if you only get filled on maybe 1 or 2, your risk is going to be 0.25 to 0.5% of your account balance. But the beauty of this is that you're going to be in the trade, right? So you're going to be in the trade, and instead of saying, oh man, I missed it, you're going to be in at a good level. And this is really going to help you kind of hold on to those stops and to honor those stops, because if you don't get filled on the complete amount and you still get taken out, there's only 1% of risk, 1% of your account capital that goes to the market, right? So that is another great way to kind of prevent yourself from not honoring the stops, is to trade a little bit smaller and to break up your trade idea across several price levels, so that you can have an aggressive level, a more conservative level, and an ultra conservative level. So that way, whether it goes in on 1 and stops you out, or it takes you in on all 4 and stops you out, at the end of the day, it's only 1%, and it shouldn't really have much of an effect on your trading. All right, trade pros. And so the 3rd actionable tip that you guys can do, and this is, I kind of have a little laugh on my face because it's called the Georgian Gale. And this is based on one of the strategies used by our head trader here, George. And what this means is, it's kind of on the back of the martingale, but it is the furthest thing from martingale. We do not encourage you guys to martingale on your positions. What the Georgian Gale simply means is that if you have an idea and you have that idea at a certain level, let's say you want to get long on an S&P contract, once it hits a certain level, you can give that idea maybe 2 or 3 shots. And so this kind of builds on the previous example, where you can take a single trade idea and break that down across several layers, so that you're risking 0.25% on each one of them. The Georgian Gale is different in the sense that if you're looking to get long off of support, all right, let's say the market has an impulse, marker's not really working, has an impulse, we get that little bit of a pullback, and then the market starts to rotate. And let's say you get long down here with the idea that it's gonna continue going up. Let's say you get long out there, the market kind of dips below that level, takes out your stops, and then the market kind of reclaims that level, continues higher, and then pulls back and starts rotating. The Georgian Gale is effectively giving yourself, another shot if you get stopped out. The key thing here is that you get stopped out first. You don't add to a loser, and you do not remove your stop losses. You keep your stop loss intact, and you respect your stop loss. And if you get stopped out on the first time, you can give that another shot if the market comes back up and shows you the qualifiers that you're looking for. That's called the Georgian Gale, and I wouldn't really recommend this to newer traders, But this is another way that you can kind of program yourself almost to respect that stop loss. All right, knowing the fact that, man, if I get stopped and this thing goes in my direction, I'll be pissed. You've got the Georgian Gale and you've got the previous example in order to help you kind of honor those stops and honor that trade idea. All right, trade pros, and here's the fourth and final practical tip on how to honor your stop losses, and that's to practice scratching. All right, not scratching because you're itchy, but you're going to be practicing scratching in the sense that, you know, if you get into a trade, your qualifiers are present. Let's say you get into a trade because of 4 qualifiers. You need to see 4 things happen in order to qualify that trade and pull the trigger on it, right? Let's say you qualify the trade, you pull the trigger on it, and let's say the market hasn't stopped you out, but 2 of your qualifiers have fallen off. Let's say you got in because of correlations. Let's say you got long because NASDAQ was leading the charge higher and NASDAQ has started to consolidate and started to pull off of its highs, right? So let's say that's one of your qualifiers. And let's say a second qualifier is that there was buy imbalances moving higher. So that's showing that buyers are getting more and more aggressive accepting value. Let's say those are the qualifiers, those are gone now. Now the trade has turned from something that had an edge, all right? And the longer that you're still in that trade while your qualifiers are falling off, that becomes hope. So the longer that you sit in that trade goes from having an actual edge to having no statistical edge and becoming hope. It is at that point where you want to scratch the trades. All right, and so what scratching will help you do is, number one, it's going to help you get out of trades that you don't like a lot quicker, right? Number two, it's going to help you prevent taking full stop losses. All right, so on the S&P 500, we risk 5 ticks on average for our trades, right? So a 5 tick stop, if you eat the full 5 ticks, that's considered a full stop loss. However, if you can scratch that trade for -1, -2, even -3 ticks, you're not eating the full stop. And what that's going to give you confidence to do is to get into trades, number one. And number two is to accept the full stop when it does get hit. Because if you're not taking full stops on average, guess what? If you do take a full stop, it's not really going to affect your psyche because you have the ability to scratch and you're comfortable getting in and out of trades. All right. And I'd highly recommend doing this at first on demo and really focus on qualifying trades. And then when those trades that you qualified, when those qualifiers fall off, and if you haven't gotten stopped out yet, that can be a good time to give it a go and to scratch the trade. All right. You'll hear this from a lot of successful day traders. They scratch often, right? A lot of traders will try, if they've got a long idea and they want to try it based on what I told you guys, a lot of traders will try the trade, maybe once, if timing's off if timing's good right away. However, sometimes the market conditions aren't there. You get into the trade, something changes, you can scratch out of it. You might have to do that 2 or 3 times before the market actually goes. And so from the trading and from a psychological perspective, it's a lot easier to be in the right position in the markets when, let's say, you've taken 2 or 3 stabs at it and you've taken -1 or -2 ticks several times. Instead of taking one shot at it, getting stopped out, and then the market comes back, now you're pissed. Now, you have a vendetta against the market, and now the market's likely heading up to your profit target without you. However, if you would have been diligent, if you would have been patient, if you would have qualified the trade and then scratched it when it turned into hope, by the time that the real setup forms, you should have enough mental capital and actual account capital in order to be able to capitalize on that trade. So that there, guys, is the number 1 rule that 99% of day traders break, and 4 actionable tips or solutions that you guys can start employing in your trading in order to find consistent profitability. Again, guys, this has been Mark from TradePro Academy. If you guys have enjoyed this video, please make sure to smash that like button and to leave a comment letting us know that you enjoyed it. Until next time, guys, good luck and good trading.